So we have another question about someone selling their company. They want to know what should I be aware of tax-wise as I'm thinking about selling or transferring ownership of my business.
Okay, so the exit planning should be done years in advance, ideally at least five. And ideally, no, ideally when you start. So there's a couple big things when it comes to exit planning. And I'm not going to have the time to go into every single one, but there's a couple big moving blocks. So one is it depends on the size of your business. If you are under $5 million of sale price, generally you're going to be selling to another individual investor or maybe a small group of investors. If you're over 5 million, then you start to attract the attention of the private equity shops and the hedge funds and all that kind of stuff, the smaller guys in that world. Obviously, most businesses sell for less than 5 million bucks. So there are a couple tax incentives that exist for selling your company. So the most basic one is that the most sales are asset sales, meaning that your company has some intangibles like goodwill or customer lists or contracts or whatever, separate from like physical equipment. So we live in a surface-based economy these days. Most assets that are sold, most businesses are sold as asset sales. Most asset sales consist of intangibles. And so what you end up with is a very low cost basis on those assets. And you end up with long-term capital gains. So that's thing number one. And long-term capital gains is going to be relatively advantaged compared to ordinary income. So depending on how much you are actually making overall for the year, you're looking at either 0%, 15%, 20%, or 24% when it comes to federal taxes for long-term capital gains. So at the highest levels, it's 24% as opposed to 37% on the highest federal ordinary bracket. Incidentally, the Biden administration, when they released their 2025 proposal, they want to get rid of that. So that's something worth noting. So you're already cutting your taxes not quite in half, but close to half, 40% or so, just by doing that. And that's like the least efficient thing to do. So from there are other options. There are people who have set up deferred sales trusts, which is an interesting strategy where basically the money goes into a special vehicle and then you get paid out over time and it spreads that impact out over time so that you can you can play the rate game so that instead of paying 24%, you're paying 15%, and then you can break it up over a couple of years. There's stuff like that. But the bigger things are the if you have stock sales. So in order for the stock sales to work, you have to have a C corporation, which is not a pass through. So most small businesses operate as pass throughs. The vast majority do because in most scenarios, it'll lower your current year taxes significantly. And money now versus money later, money now is more important, just time value of money calculations. So if you forego that though, then you have two big incentive options. So option one is the ESOP strategy, where if you sell at least 30% of the stock to your employee stock plan, then and you got to get independent valuations and all this kind of stuff. There's a bunch of rules to follow. But if you do that, then that is tax free for you. And the thinking there is that you're sharing the wealth with the people who built the business. So that's a great potential incentives. The other incentive is 1202 treatment, which is founder stock, where if you own a C corporation for at least 5 years, and there's certain date ranges that apply, but basically all companies at this point qualify, you can sell the stock for up to a tax-free amount of 10 million bucks. So that is a huge incentive. And again, the idea there is that we want to reward, we being the Congress, we want to reward people for building businesses that provide economic value and then getting that value working in the wider economy. And yeah, so potentially 10 billion bucks tax free is amazing. And in most states, that carries through on the state level as well. So it's a fantastic incentive. But the problem is that, like I said before, most sales are not stock sales, they are asset sales. And the reason for that is because the buyer, if they buy your stock, they're also buying all the history of whatever happened before, which they have no control over. If you just like if you're in like on the stock market, if you buy a stock and that company gets sued for something that happened 5 years ago, that's still going to affect your stock price today. So the same issues happen potentially with selling your own stock of your own company. And so because of that risk factor, a lot of the vast majority of sales at that level are done as asset sales because that severs the history and the liability from the old entity to the buyer. But that is a potential negotiating point to work in. It says if I sell you as stock, then my tax impact is way better. I know you want the asset thing, but maybe we can meet somewhere in the middle, and then that's just a negotiation to have between the buyer and the seller at that point. So we've got a few clients that are attempting that particular strategy, but it's a multi-year process. So we'll see how it goes. But that is my
Understood.
and that's not everything when it comes to exit planning, but those are some of the big moving pieces.